Ford and Stellantis reporting disappointing earnings this week, sending their stocks tumbling. And despite GM beating expectations, its EV expansion delay is weighing on its stock. To discuss which car company is best positioned for the rest of the year, Daniel Roeska, Bernstein senior analyst, joins us now. And just give us your big picture overview of the results that we got this week. Any surprises?
Hey, good morning, Jared. Thanks for having me. Look, I think first half and Q2 actually was not terrible. What really spooked investors this week is the outlook into the second half, where companies across the board signaled that they expect a weakening U.S. consumer landscape.
Dan, when it comes to what that tells us, maybe once you dig into these reports, there was a lot to like within the GM report. You take a look at investor reaction to Ford. It looked like something was missing there because we didn't have that beat and raise that it looked like the street had been anticipating. What does that then more broadly tell us about the landscape ahead for so many of these traditional automakers and maybe how tough the road could potentially be here in the short term?
I think, look, two things. On the short term, this is all about earnings revisions, and what we heard this week will take earnings down, and so that's the headwind we're seeing. In the medium term, I think you need to realize that Ford wants to keep the cash to preserve strategic optionality, whereas Stellantis and GM are still distributing a significant amount through dividends and buybacks. And I think if you look out until end of the year into next year, you probably want to have a stock here that's paying you to wait, because it'll take until mid-25 before U.S. consumers wake up again and we get the engine restarted again on autos.
I want to get your take on Tesla. They were able to increase their deliveries to 444,000 units, but there are lots of promises. And bottom line, they sport a 88-time multiple on Ford PE. I'm just wondering, is Elon's behavior justifying that Ford multiple?
I'm going to be careful on that multiple because, of course, there's a lot of enthusiasm around all the things that are not cars that is built into Tesla. And I think that's really what you need to look at. They're trying desperately not to be a car company, quite honestly. The way they talked about Optimus and the other opportunities on the earnings call, right, shows you. I think on the segment of cars, what you got to realize is there's going to be a model refresh in 2026. And the new model, kind of Tesla 2 or whatever the name will be, likely is 27 and later. And that means any significant volume growth on the key aspect of cars at Tesla will likely have to wait quite a bit. And I think that's really what's weighing on the stock right now. And that's also what our team kind of sees in the future for this company.
Daniel, you characterized Stellantis' quarter as, quote, it's a miss all around and takes us into, quote, uncharted waters for this group. What do you mean by that?
Well, look, we've got one of the best CEOs in global autos running this company, Carlos Tavares, right? He's a master at, the cyclical industry. He cuts costs like nobody else. Yet here we are in the situation where Stellantis did all the wrong things in one quarter, right? They pumped the inventory channel last year. Inventories went up. They had to put discounts back on. They had to put pricing down. They overspent on M&A. They overspent on CapEx, and they basically had no free cash flow in the report. And this is really the first time in the past 3 years that Stellantis has messed up, right? So far, this has been the poster boy of global autos with a very strong track record. And so this raises questions whether the performance of Stellantis, or how much of the performance of Stellantis over the past 3 years was due to the great M&A and consolidation between PSA and FCA they did, and how much was just due to the lack of supply and the supply chain issues we've had driving up prices.
What do you think that then tells us about the price strategy moving forward? Do you think we'll likely see price cuts as a result of some of that weakness here?
Yes, look, if we look at the inventory levels right now, we're about 25% higher than where we should be in the US. And that means everybody across the board, but especially Stellantis in some of their segments, will need to cut pricing or find some way to entice consumers. What we're seeing as a reaction, in addition to pricing, is that OEMs will cut production in Q3. That relieves inventory pressure into Q4. And so if you're looking for a car deal, Labor Day is the day to go. I think up until then, we'll see consumers being in a better place to buy a car, to kind of get a good deal. After Labor Day, you'll see some of those production cuts come through into Q4. And so by the end of the year, I think we'll have worked through this. And again, this is a typical auto cycle. This is nothing to be afraid of, but it does weigh on earnings in the second half.
I'll give you the floor here for the last one. Anything you want to leave investors with here?
Look, I think autos is autos, and the past 3 years haven't changed that. And so it's a cyclical industry. You need to think about the near-term earnings. We think GM here is best positioned to tide people over with a good buyback and dividend strategy. In the medium term, though, we'd flag that everybody, Stellantis, Ford, GM, they're all working on the future platforms, on the electric vehicle platforms, and they will be around. They will be a part of this market. And so in the very long term for investors on autos, which is 3 years, I'd argue these companies are going to be around. They're going to have better earnings than they had 5-6 years ago. And so ultimately, valuations will have to come up on this sector, but that is not something for today. For the next couple of weeks, this is all about second half. And I take a deep breath, step back, look at your portfolio, and if you want to be active, I would look for a stock that's compensating you for to wait, and that's basically GM at this point in time.
All right, Daniel Roeska, great to have you here. Bernstein's a senior analyst. We appreciate the time.